In this video, we are going to cover an example of a cash disbursements budget. So as we've covered in the previous lectures, the cash disbursements budget is just one piece of the overall cash budget. We've already covered the cash receipts budget, dealing with sales and when we receive those. Now we're dealing with the cash disbursements budget, which some of the things we talked about in the cash receipts budget kind of apply to this one as well. Really the carryover from one month to the next as far as the payments for our merchandise. So we're going to see that same concept where they span into another period. But for the rest of it, we're going to have a variety of different things we're paying for in a given month, but we don't have to worry about carrying that over from period to period with those. So what I have here, we have some information we'll go through, and then at the very bottom you'll see we have a little template that the whole point of this is to fill it out. So we have the cash disbursements budget for this entire quarter along with quarterly totals. Very similar to the cash receipts budget. I had these lines or these columns, these rows in yellow, basically identifying the accounts payable balance at the beginning and at the end. Now notice these are informational only. They'll be needed if we were to do the balance sheet later on, but they're not part of the overall calculation. We'll handle the calculation items in the white rows instead. So let's start up here. The most complex portion of this exercise is the direct materials purchase because, again, the payments are made in multiple periods. So we have 3 months of purchases. Now normally you would get this from the actual direct materials budget. You should have already completed that, and of course that would be based on the production budget. What do we actually need for this period? But here we just have the purchases themselves. So because we're just working on this one budget, so we had to have this information. These are purchases, and of course we're going to eventually have to pay all of this money back to the vendor. But we have to have information like this, where it says materials are paid 25% in the month of purchase, and the remaining 75% in the following month. Now here they're telling us that the accounts payable balance from December of last year, in other words, the last month prior to this quarter, was $3,000, and it was all related to material purchases. So that $3,000 is what we're going to have to pay, first of all, this in January. We've got to pay the $3,000, plus we're going to have to pay for 25% of January's. And then the other 75% of January's will be paid the next month. So let's go ahead and take that information down to the chart. Now, there are a variety of ways to format this. The way I'm formatting it is we're just going to basically report the actual payments we're making for that particular month. So we're going to pay for each of these 3 months in their respective months plus the following month. So the first thing we need to worry about for January is paying off the $3,000 from December. So what I'm actually doing here, again, this is informational only. We have $3,000 left from December to the beginning of January. Again, that's informational though, so we're going to actually create a line here where we're basically saying this is January or December 75% paid in January. And you can type in whatever you need there. December 75% purchases paid in January. Something like that. So that's where the $3,000 comes from. And then what we're doing in January is paying January's 25% of the purchases paid in January. So that's going to be, if we wanted to put a format here, it'd be 25 or 0.25 to get 25%. So we'd say equals 0.25 multiplied by January's $15,000 of purchases. So that'd be $3,750. That's all we have for January. Now the other, we'll go ahead and put it in here. January's 75%, I'll just overwrite that. 75% of the purchases paid in February. So that's going to be 0.75. Oops, sorry. We don't want that here. We actually want that over in this cell. in February, because we're paying it in February. 0.75 of January sales, that's being paid in February. Now, what that actually would have been, what I was initially going to do is that is the $11,250 that's due, that's accounts payable at the end of January, because it's going to be paid in February. It's a liability in January. We're paying it in February. So that same $11,250 goes up to the beginning of February. Again, depending on what exact problem you're working on, what template you're given, what your instructor requires, you may not have this informational piece, and that's fine, but you'll need to know the information still for the balance sheet. So that's all I'm trying to do, is just clarify that some of this information carries forward. You can leave it out, you could delete these and it'd be just fine, but this just kind of clarifies what's going on. So we've taken care of all of January's purchases. One thing to remember, with the cash receipts budget, sometimes we had a bad debt amount. We said we'll probably won't collect the remaining 5% of these sales ever. We can't do that with a purchase budget. We can't, as a company, decide, hey, we're not going to pay our full amount due. That just won't fly. Now we're going to do February's, and in fact, I'm just going to copy these down here and then just retype them. February's 25% purchases paid in February. Same month, basically. And the next one, oops, if I spell right, February's 75% purchases paid the next month. So again, 25 in the current month, 75 in the next month. So the rest of what we're paying in February is 25% of February's purchases. Now, the 75% of March's purchases, oh, I'm sorry, 75% of February's purchases paid in March is going to be 75% of this amount. So now notice, if I was to sum those two up, it's $25,000, which is exactly what February's purchases were to begin with. It's just covering two separate months. So here we have 75% of February's purchases paid in March, and I'm going to do the next piece, the other piece that's paid in March. It's March's 25% of the current month purchases paid again that month. So 0.25 of March's purchases. Now remember, there's one thing I missed down here. This was the ending balance for February, which isn't going to be paid till March, so it's this $18,750. It's the other 75% of March's or February sales that are due in March. And that would have also carried forward to be $18,750 for March's beginning AP balance. And obviously we're actually paying it, so that's why it's in the white area. Now we have March's 25% of purchases paid in March. The other 75% of March's purchases are going to be paid in the next quarter altogether. So 75% of March, that's what's going to be left at the ending of March, the ending of this quarter. So before we go much further, remember in the cash receipts budget, we said that the beginning and ending amounts for a quarter, they're not a sum. They are actually the beginning of that quarter. So for the quarterly beginning balance, we have to go all the way back to January. That's the beginning of the quarter, so it's also January's beginning balance. But for the quarterly ending balance, it's the end of the quarter, which is March. So again, don't try to sum those up to get a quarterly total. It's the very beginning of the quarter or the very end, depending on what you're looking for. Now, a couple ways you can do this. You could actually, if you wanted to, get a sum for each of the rows here, but it really isn't all that informational until we get down to the very bottom. So I'm just going to leave this out. If I wanted it, I'd just carry over the total for all of these, but I'm just going to wait until we get to the very end. We have our materials purchases. We could create a subtotal if we wanted to, but I'm not going to bother with that. Instead, we're going to go below the line to create the rest of the purchase or the rest of the payments. So we're done with materials. So we're done with all of this. Now we just have direct labor. And this one's an easy one because we just simply carry these amounts into the budget. We don't have to worry about one month to the next. We just carry these amounts and plug them in to their respective months. So I'm going to type in direct labor payment, and I'm just going to link them to their actual month. So 9,800 goes there. 10,100 goes there. And 11,000 goes there. Now again, we could do a subtotal if we wanted to. It's not really that important. We're worried about the grand total at the end. So we're done with direct labor. Now we have fixed manufacturing overhead. There's an important piece in here that you need to pay attention to. Now, sometimes, again, this would generally come from the fixed manufacturing overhead, or I'm sorry, the manufacturing overhead budget, and it'll tell you both fixed and variable. So with this, we need to know how much are we actually paying. It says it's $3,000 per month, but $1,000 of that is depreciation. So we're not paying the $1,000. And that's the key thing. Depreciation is not a cash expense. We actually paid for that way back in the beginning when we first bought the asset. So yes, we're expensing it over time, but it's not a payment. So we have to subtract that $1,000 out before we get to the cash budget, which basically means we're paying for the other $2,000 of fixed manufacturing overhead. Whatever that might be, salaries of some sort, or it's not depreciation though. The $1,000 depreciation is carved out. Now, sometimes this is done on the manufacturing overhead budget. You'll see a bottom line kind of subtracting this out to arrive at the cash payment. In other cases, you have to do it just on the cash disbursements budget. That's where you do all the calculation. So we know it's $3,000 minus $1,000. So I'm going to say fixed MOH for manufacturing overhead payment. Now this is the same every month. Not all problems are going to be that way. Sometimes there's a planned change in fixed manufacturing overhead. Has nothing to do with the actual change in activity levels, because if it did, it would be variable. Instead, it might just be, you planned to do something additional in that certain month. Maybe the salaries were increasing or whatever it might be. But in this case, every month is the same. It's going to be $2,000 of cash payment. So there's nothing really to link to there because I put them all in one sentence. Variable manufacturing overhead is $4 per unit, and we have the units produced from the production budget down here. Now this is another important thing I want to mention. I've seen this handled a couple different ways on problems. Sometimes they apply variable overhead based on the number of units. Sometimes they'll apply variable overhead based on something like machine hours or direct labor hours. You have to pay close attention to what the problem says and make sure you use that proper driver, that cost driver. In this case, our cost driver is simply the number of units, but if it were hours instead, then we'd have to go back to the direct labor budget to get the number of hours used for each month to multiply by whatever the rate is, $4 or whatever. But this particular version just says we're allocating overhead based on a per unit basis, and here are the units. Again, you'd normally get it from the production budget, but we don't have that, so here's the number right here. So that's variable overhead. Now this is going to be $4 times the number of units for each month. Now I could, again, the $4 is inside of another cell, so that's why I couldn't really link to that. Sometimes the information will be in its own cell and you can link to it. But for now, we'll just type in $4. Make sure everything looks good. So now we're done with variable manufacturing overhead. Now we have another cost. In this case, it's fixed. It says we have $5,000 per month for administrative salaries, $1,500 per month for rent, and $750 per month in depreciation of equipment. So again, a couple of ways we could do this. We could just make this one big line for fixed selling, administrative, and general, including both of these two expenses, but not including depreciation. Or we could break it out into administrative salaries, rent. Either way would work, but I'm going to go ahead and merge it together into one line. So I'll just call it fixed SG&A without depreciation. So that's going to be the $5,000 plus the $1,500 per month. So that's what we're saying there. It's $5,000 per month plus $1,500 for every month. Oops. So $6,500 for each of the months. I'm going to put in payment here so we know exactly what it was. Again, a lot of times that would come from, it should come from the fixed selling, administrative, and general budget, or just the SG&A budget, I guess. There might be variable and fixed. In this particular example, it's just fixed. If it was variable, if they had variable as well, you'd have to know how do they apply variable overhead, variable fixed SG&A overhead. It might be a percentage of the dollar sales. It might be so much per unit sold. They usually don't use hours for that, but you'll need to know if it were variable, what is the cost driver, and they'd have to give you a set of numbers or quantities for the cost driver. In this case, we just have fixed. Now we have dividends payment. So I'm going to type the label in here. It's $2,000 expected to be paid out in February, just in that 1 month. So 0 in January, 2,000 in February, 0 in March. And then it says income taxes are expected to be paid $3,000 per quarter due at the end of the quarter. So I'm going to say income tax payments, $3,000, and nothing in the first 2 months. Again, for each of these lines, we could get a subtotal if we really wanted to. It depends on what your template looks like, what your instructor or the textbook question requires. We're going to leave the subtotals out. Okay, so let's sum this up here. And we needed to grab all these amounts here and then put just a comma and then grab the remaining amounts. So basically you're summing two different series here. And that's why I did this, because it's an important tool to know in Excel. If you don't want to sum the entire column and you need to grab multiple series, then you would do your first series, B34 through B45, and just a comma, no spaces. That's where I made the mistake the first time. And then your second series, B47 through B52. And it should be good to go. Another thing I'll mention in Excel is that once you have a formula, if everything's set up the same in multiple columns, you can drag that formula over and it'll update based on the new column C or column D. So that's what we have here. And finally, we do have to do an actual sum across for the cash disbursements. We do want a grand total of all the cash disbursements. Now here I'm just going to go back to your basic adding cells just to show you another way of doing it. You don't want to do this if you have a bunch of columns or lines, but we only have 3, so it's not a big deal. So we'd pick B53 plus C53 plus D53. Nothing too tricky with that. And hit enter, and we have a total of $143,063 of cash disbursements. Now, if we just want to check it, this is one other way of doing things in Excel. If you just want to check it without it actually fitting into a line somewhere, if you highlight all the cells in question, down here at the bottom, you'll see the sum. You'll see a count, you'll see an average, and a sum. And the sum is indeed $143,063. That's what we're looking for here. So I'll scroll back through this. Well, we already have the information, but I'll scroll back through this just in case anybody wants to see it again. Here are the materials section and the other payments section. So hopefully this has helped to clarify this particular cash disbursements budget example. But I thank you for your time, and we'll be coming back with the cash budget, the overall cash budget in just a little bit. Thank you.